Well, it was another week of record highs across the equity complex last week, while treasuries softened just a touch across the curve and the dollar continued to lose ground as this dovish Fed repricing rolled on, despite what was ultimately a mixed July inflation report. This week, focus turns to Wyoming and the Jackson Hole Symposium, mainly for Fed Chair Powell's remarks on Friday to take us into the weekend, though trade and geopolitical developments will be eyed as well, plus a busy data docket awaits here in the UK. Plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So it was a busy week last week as markets cheered the continued dovish repricing of Fed policy expectations. And of course, over the weekend, football fans cheering the return of the Premier League where the mighty Gunners won an ugly victory at Old Trafford yesterday. And of course, the Black Cats mauling West Ham on Saturday afternoon. Joining me, as always, to make sense of everything that's going on is my good friend and West Ham, long-suffering West Ham fan, Ryan Littlestone from Pepperstone Live and Analytics. And Ryan, question for you to kick the show off this week. When does Graham Potter lose his job?
So in the space of 30 seconds, we had two bad puns, and now you're whipping me over the coals over one result. I don't know. I'm looking for my red and yellow cards. I think the kids have
lost
them. I think the kids have borrowed them.
Oh dear, what a shame.
Yeah, well, shame for you it is anyway. So look, you enjoy the first week of the season. It's probably the last win you'll hopefully get.
Well, I did say to you earlier that, within 3 weeks I'll be back to being depressed, and your words were I'm selling 3, which I think is probably your most profitable play of the day that we've had.
my play of the day this week, probably selling West Ham over the next few games.
Well, that's not a bad idea. Anyway, enough of football chat. There's plenty of going on in markets, so let's get into Topical Thunder. So it's that time of year again where we all turn our attention to Jackson Hole in Wyoming. I believe my invite must have got lost in the post somewhere because it still hasn't arrived. I don't know whether yours has made it all the way down to the south coast yet, Ryan. But
yep.
Sorry?
Yeah, it has. Yeah, I believe in Friday afternoon.
Oh, good. Well, have a safe trip, mate. You can report back next week in that case. In any case, we've got to wait until Friday afternoon for this week's main event. I think there'll be a lot of twiddling of thumbs going on before then. And that is, of course, when Fed Chair Powell will be speaking at the annual Jackson Hole Economic Symposium. Now, markets remain pretty much all in on the idea of a September rate cut. We're priced at about 85% now for a 25 basis point move at that Fed meeting. And that's despite a bit of a hot CPI number last week. Headline in line with expectations, fine, but core CPI north of 3%, super core CPI north of 3%, and core goods inflation running its highest level in over 2 years as well, having been in outright deflation just 6 months ago. So the data, despite the way the market's viewing things, the data, in my mind, not really pointing towards the necessity for a rate reduction in 4 weeks' time. Fed Chair Powell has pretty much two choices in his remarks. He can either endorse the current market pricing, lean explicitly into the idea of a rate cut in September in order to support the labour market, and express a relatively high degree of confidence with inflationary pressures being temporary or transitory, to coin his old language. Alternatively, option 2 is to really keep his options open, stick to the script from the last press conference. September might be a live meeting, of course, but I don't think Powell is going to want to pre-commit to any sort of action at that meeting because consider we are 4 weeks away from that September FOMC meeting. We've got another jobs report, we've got another CPI print, and we've got the July PCE data all to come before that next Fed decision. So I would not be at all surprised if we ended the week with market pricing for September a lot closer to a coin flip than it currently is, because not only consider the deluge of data we've got to come, not only consider where inflation was last week, but also, of course, inflation risks remain tilted firmly firmly to the upside as Trump continues to throw tariffs around left, right, and centre. In terms of a bit of a market playbook, I think if Powell doesn't endorse a move next month, then you're going to see a bit of a knee-jerk hawkish reaction. The dollar higher, front-end treasuries sold, and stocks taking a bit of a leg lower into the weekend. And the converse of that will obviously be true if Powell is overtly dovish. But I think the best framing for this is, I would argue, even if Powell does not want to rock the boat in Wyoming this week, by trying not to rock the boat and sticking to his script, he's probably going to end up rocking that very boat because of the dovish nature of current market pricing. So it could be a little bit of a subdued few days, but plenty of excitement awaits to see us into the weekend, I would imagine.
Yeah, well, I don't know how many boats will be involved over that symposium. Isn't it the middle of farmland or something? I don't think there's any water nearby.
Well, there's a lake there. You can see that from the picture.
Oh, we can go fishing
Maybe
then.
a kayak rather than a boat.
Yeah, a conch. But yeah, I agree with what you're saying, and I also agree with the pricing. You know, we're seeing the market price an 85% chance of a cut in September. I saw a poll from Reuters, which pretty much puts economists down at around 60% view of a cut coming September. So there's a bit of disparity between different aspects of the market looking at this meeting. But I also think he's going to have to walk this fine line. Is he going to panic over the jobs numbers, especially when we've seen, multiple inflation readings now pointing higher? It really is still just one jobs number that went a bit wobbly, and I can't see them panicking over that. So really, there's going to be some disappointment one way or another. Either the Hawks are going to get disappointed or the Doves are going to get disappointed. So I think whatever happens, like you say, there is potentially going to be a big market move. Obviously, the biggest market move, again, as you say, is going to be if he doesn't indicate that a cut is, really a strong chance of happening, because then the market's just going to really reverse the other way. And then we've literally, if we're rubbing that meeting out, we've got two meetings to do these two cuts that a lot of the dot plots are predicting. So what happens after that? Another hot inflation report, jobs get back on track. And then we've got the potential of maybe seeing one, if maybe no cuts for the rest of the year, which again will cause a bit of a reprice. So as much as you might want to avoid any inflammable comments, I think, like you've said, he can't get away from it. Something is going to happen at this meeting.
Yeah, absolutely. I fully agree. And of course, we do get an updated dot plot at the September meeting. So it'd be very interesting to see how that pans out, of course, depending on the rate decision at that meeting as well. I think we touched on this last week, but the reason why I'm erring towards Powell just keeping his options open as much as he can is because the sort of nightmare scenario would be, if you think back to last year, where Powell stood up at Jackson Hole and went, the time has come for policy to adjust. The nightmare would be for the Fed if he did a similar thing, which I don't think he's going to do, but if he did a similar thing this year, and then you get a really strong August jobs report and a really hot August CPI number, well, a fortnight prior, Powell has come out and gone, basically, we're cutting. Then the data says you don't need to cut. The Fed are then going into a meeting with the market priced for a cut that they're probably going to have to deliver, but that they don't really need to be delivering. So I think with 4 weeks to go, if Jackson Hole was held the week before a Fed meeting, I think they'd be much more comfortable being much more explicit. But given the length of time we've got, and especially nowadays, 4 weeks is effectively like a decade in terms of how much can happen in terms of trade, in terms of the economy, in terms of geopolitics. I just think the most logical thing, the easiest course, is just to keep as many doors open as possible, even if it upsets the markets for a trading session or two. It's probably the more prudent course in the longer run.
Yeah, absolutely, and we know he's become an ace ever since the old inflation transitory saga and getting it wrong a couple of years ago. He's become very good at guiding the market and saying not a lot and just keeping the message going. Yes, this is where we're at. We've got risks on both sides. If we see those risks by the time we get to the meeting, we'll act. If we don't, we won't. And even if he sticks those lines, it's still going to get the market moving because of the way it's priced going in. And that's one thing I always tell traders, when you're looking at these events, central bank meetings, you have to know where the market is at going into that meeting, whether you believe what Powell's going to do or not. know where the market is, because then you know where the biggest price risk reaction is going to be.
Yeah, that's absolutely pivotal. Knowing what's priced in is always key. Anyway, we are 4 weeks out from the next Fed meeting, but we are 2 days out from a policy decision down in New Zealand.
Yeah, absolutely. And the market's expecting the RBNZ to take rates down 25 pips to 3%, which is quite significant, as it's going to put their rate right in the middle of their neutral zone, which is 2.5 to 3.5%. So this could be the perfect time to see the RBNZ maybe take their foot off the gas a little bit and maybe move into a bit more of a balanced rhetoric. Now, the RBNZ are a bit of a funny lot. During the inflation blip, they took rates up to 5.5% before starting their cutting cycle with a 25 pip cut. Then they went to 3 50 basis point cuts, and now they've gone back to 25 basis point cuts to get them where they are now. So with the world and his mate expecting a cut, the bigger price risk moves to them, perhaps shocking the market by keeping rates unchanged. But if they do cut, that won't really be news at all. With rates now around 3%, it's what they're going to say about future moves, and that's where I think the main price action is going to be. Now, one pair I'll be looking at for this is Aussie Kiwi, as I've been eyeing up a short build to play some of the levels in this near 11-year range that the price has traded in. So if they indicate that they're moving to a pause, I can see room for a dip in this pair. But as it's been pretty strong in the short term, since the April lows really, I can see that dip getting bought up. But if they stay dovish, that's just another reason for this to keep looking up and taking on some of those big range levels, the first of which is at 110.20. Now, the basis of this trade that I'm looking at is mainly technical and scaling in against some of these big levels. And for those with good memories of the show, this was a trade I played in late 2024, 2025. But there's going to be something in this one, I think, for both short-termers and long-termers alike.
Yeah, I would agree with that. I've got to laugh when you've picked a pair there that hasn't moved for getting on for 11 years now, but there we are. It's a bit like Euro Sterling in many ways since Brexit. I think it'd be a surprise if the RBNZ didn't deliver a rate cut this week. But as you rightly say, I think we're not just for the RBNZ, but I think globally we're moving to a point now where, given that a lot of G10 central banks are at or very close to neutral, you look at the RBNZ, you look at the Bank of Canada, you look at the ECB, Swiss National Bank at zero, so that's a slightly different question, of course. The Riksbank in the mix as well, they decide policy this week and they'll keep rates unchanged. But we're now in a case of, firstly, these central banks fine-tuning policy. Is another 25 basis points needed to provide a bit more support? Are they looking at, like the ECB, the risk of a sort of sustained inflation undershoot? But also we're at the point where the rate decision itself doesn't matter quite as much as the guidance that accompanies that rate decision, because we're now going, well, actually, where is the terminal rate for this cycle? And I think we'll probably get at least one more cut in New Zealand. They may even want to go down to the bottom end of that neutral band, but that is very much the sort of global debate now. It's not so much, in the US and here in the UK, it's a case of when is the next cut coming, because things are slightly different. Japan, obviously a bit of a special case. Everywhere else in G10, it's pretty much a case of, firstly, are they going to cut again? Is there a need to cut again? And secondly, if they are, how much further do they actually need to go? Because outside of the SNB, who I alluded to, I don't think anyone is going to want to get anywhere near that zero lower bound if they can at all help it. And the bottom range of their neutral estimate, 2.5% in New Zealand, 1.75% in the Eurozone, wherever it may be elsewhere, that's probably where central banks in an ideal world would want things to be bottoming out this cycle.
Yeah, absolutely. And what you've got to realise as well, particularly with trading something like the Kiwi, is it when everyone knows which way the central bank's going, you tend not to get too much of a reaction in the currency. But it's when the market sees or gets that change in the cycle, whether it's a pause, whether it's turning more hawkish, whatever, that's when you can tend to get a bit of a bigger move and some increased volatility. So that's one of the reasons I'm looking at the Kiwi this week.
Yes, absolutely. Now, I'm assuming, given that you don't even get up at 7 a.m. for UK prints, I'm assuming there's absolutely no chance you being up at 3 a.m. or whatever it is for the RBNZ on.
I don't know. I might surprise you.
Well, I mean, you can surprise me when I wake up a couple of hours later, because I'll be fast asleep in the land and nod. Anyway, speaking of UK data, let's move on, because we've had I think we're in our third week now of very, very busy weeks here in the UK. Obviously, we had the BOE at the start of the month with that bitterly divided MPC voting 5-4 to deliver a 25 bip cut eventually. Last week, we had another busy week with the latest labour market stats, which they weren't great, but I guess if I was being charitable, you could say that they perhaps showed signs of the labour market bottoming out. Unemployment held steady at 4.7%. Payrolls, yes, they fell for the 8th month in 9, but they did only fall by 8,000 in July, which is a tiny percentage compared to what they have been falling by. So I don't think we can sound the all clear there, but nonetheless, potentially some small green shoots emerging. We also had the latest GDP data, which was better than expected, with the economy growing by 0.3% on a quarterly basis in Q2. But that growth came for entirely the wrong reasons. When you dig in to that GDP report, which because I had had my Weetabix and was up early, I was able to do, you would know that government spending propped up the entirety of that economic growth. When you actually look at the private sector, business investment in Q2 fell by 4% on a quarter-on-quarter basis. So if the government hadn't increased spending so significantly, which I would argue they shouldn't be doing, given that we hear about this fiscal black hole in every single news report these days, then the economy wouldn't have grown at all. Now, that aside, it's another busy week this week. Kicking off on Wednesday, we have the latest inflation figures. Headline CPI is seen rising again to 3.7% on a year-on-year basis in July. That will be up from the 3.6% we saw in June. And of course, the BOE expecting that to get up towards 4% by the end of September. Services CPI, that's seen at 4.8%, up from a prior 4.7%, so all pretty grim there. Thursday, we get the latest flash PMIs. We also get public borrowing stats, which are expected to show a much narrower deficit in July, just about 2 billion or so. But here in the UK, a lot of self-assessment tax returns come in the month of July, so that is going to skew the data a little bit. It's not going to be sort of sounding the all clear on the fiscal front for the UK economy. And then we wrap up the week on a Friday with the latest retail sales figures, where sales are seen rising by 0.5% on a month-on-month basis in July. Risks there probably tilted to the upside. We had quite a warm July. We've had a very warm August as well. Usually there is a very close correlation between the temperature and retail sales volumes here in the UK. What does it all mean for the Bank of England? Not a lot, to be completely honest with you. Sorry to disappoint. The next live MPC meeting is not until November, at least in terms of bank rate. So I don't think that any of this data is going to move the needle too significantly. What does it mean for the pound? I would also argue probably not especially much. The economy remains basically a stagflationary shambles, in short. The only reason cable is north of 135 and has notched back-to-back weekly gains is because the dollar continues to trade in very, very soggy fashion. Personally, I remain pretty bearish on the pound, as you might have figured by now. But as you, Ryan, have said on numerous occasions, playing that in the crosses is probably the much cleaner expression in this moment in time.
Yeah, but actually the pound, particularly versus the euro, where I'm trying to build a long position, is looking quite strong after coming off some of its highs. But you know, that GDP data when I first saw it was a bit of a surprise. But as you mentioned, that's the government propping it up, so it would have been probably closer to flat, if not worse, if it wasn't for that. And that's what I was expecting. Inflation, that's going to be a big sticky point for the Bank of England, obviously. But again, just in case there's a surprise, if those numbers miss expectations, maybe even match last month or even lower than last month, that's going to catch the market on the hop, and we're going to see rate expectations running the other way and the market bigging up for cuts. But we've been discussing this morning that it seems, you know, some of the markets really looking like it doesn't fancy another cut for the rest of the year, which, as we've both been saying, and particularly going to the latter part of the year, might be a bit of a mistake, given the state of the economy and what's likely to happen over the months ahead. So, you know, do you think that this is really setting up for the Bank of England to be wrong and suddenly to rush back into cuts again?
Bank of England being wrong? That's never happened before. Ryan, go and wash your mouth out with a bar of soap. What are you on about?
I'll give myself a yellow card for that. There you go.
Oh, he's found him. Yeah, I think it is. I mean, as you rightly said, we had headlines pointing out earlier today that at one point the market was pricing a less than 50% chance that the BOE cut again this year. I'm going to talk about this a bit more in my play of the day, but I think, given where the risks to the UK economy are, they're clearly to the downside in terms of growth. They're clearly to the downside in terms of the labour market. And you would imagine that subsequently the slack in the labour market causes a decrease and a drop in demand, which alleviates some of that inflationary pressure that we continue to see. I think the risks to the economy are clearly tilted to the downside. You would argue risks to the policy outlook are hence tilted in a dovish direction. So the fact that the market doesn't even price one more cut this year, I think, if we get a soft CPI number, or even if Jay Powell starts, turning a little bit more dovish stateside, that could be enough just to be the spark that sees some of this recent hawkish move unwind in pretty rapid fashion.
Yeah, I mean, it is a bit bonkers. I mean, you match, the numbers in the UK up with the numbers in the US, and people still looking at 2, maybe even 3 cuts in the US, and we're not even looking at potential for 1 here in the UK. And that's a divergence that I'm particularly interested in as a trader, because for me, if the Bank of England are wrong and if the market's wrong about that, then that's going to be a big reaction, a potential big trade.
Yeah, the only thing I agree with you. The only thing that makes me slightly reserved and cautious about it is it feels like a very obvious divergence, and it feels like a very consensus view to sit there and go, that's wrong. Now, consensus can be right and often is right, and that actually may intensify the momentum behind the move when it does get going, because everyone will sort of pile in en masse. But it does just make me a little bit jittery when pretty much every man and his dog is thinking exactly the same thing. But maybe that will be what happens. Anyway, as I said, I'm going to talk about that in a little while. Beforehand, geopolitical developments. And you best be quick, because Trump's meeting Zelensky in about 3 hours.
Oh, yeah, in the 3 hours, and then they're going to have an 8-hour conversation. And no doubt the boxing gloves will be back on, because we've heard that JD Vance has been invited to the meeting as well. And look what happened last time those 3 got together. But anyway, yeah, we had that big summit on Friday, which ended quite disappointingly in the end. For 3 hours of talks, all we got was that they agreed on some things and did not on others, and there was no ceasefire of any sort forthcoming. However, the positives were that they will continue to talk, and over the weekend, apparently Putin has offered some concessions of NATO-like involvement in Ukraine and security guarantees. Now, there's no doubt both sides will want to end the conflict, but it's still all down to what Putin wants regarding territory he's taken and what he's happy to give back versus what Zelensky wants to take back and keep and whatever. And that's the crux of the whole matter right now. And a lot of it is down to all these minerals and stuff deposits in certain parts of the Ukraine, particularly where Russia keeps taking territory. Now, the risk for markets are that things, drag on and maybe go quiet and the conflict continues. But we're probably as close to getting some sort of resolution as we have been for years. So all sides may be willing to keep the momentum going. Thus far, risk assets haven't really reacted, anyway at all, and nor should they really, based on the news we've had. But there's still possibilities that we may still get a ceasefire of sorts, which I think will then move risk. Let's hope we don't get the worst outcome, which is if talks fail all round, Trump sort of throws his hands up and walks away from things, and then we see things get much worse. Now, I'm keeping a close eye on gold, as good news may see some of this risk premium coming out of the price here. Whether that's just another dip buy to be had remains the question. In the meantime, we're trading around a big pivot level at this 33.30 level. So take direction from what side we move or hold of that level, because it could be the deciding factor as to which way we go from here, back up to the 34s, or maybe even down to 33s, 32s, something like that. So pivotal moment here. We know what's coming. We'll all find out what happens tomorrow.
Indeed. Now, first things first, Ryan, I've got a bit of a bone to pick with you. I mean, you have not said thank you once during this show. Not once.
Thank you. Thank you for
That's
what?
better. That's better. Well, that's just how they acted with Zelensky last time out, so I thought I'd scapegoat you. Why not? On a slightly more serious note, I view the risks around all of this as a bit more asymmetric than you do, I think. I would argue that the downside risk, particularly in terms of equities and sentiment more broadly, if there's no deal, is probably quite limited. Outside of certain agricultural commodities, nat gas, maybe some of the crude benchmarks as well, I think markets at large have probably been ignoring geopolitical risk in this form for the bulk of the last 2 years. Now, that's not to say what's going on is not tragic. Clearly, it is. Clearly, the scenes you see on the news are horrifying and tragic, and we all hope that there is a peaceful resolution sooner rather than later. But I don't think we would see, and this could be famous last words, but I don't think we would see a significant degree of downside or souring of risk sentiment if these talks were to collapse. On the other hand, if we were to see a successful and a sustainable resolution to the conflict, then that could give risk another leg higher, because you'd say that at the moment there is some degree of probability that things flare up even further in the price. You can price that out. And again, you may see that show up more in some of the commodities, maybe some downside in gold as well. But frankly, sadly as well, I'm really not going to be holding my breath for any major breakthrough here. What we saw in Alaska on Friday seemed to be a complete damp squib. I think our good friend David Sheff was rightly saying earlier, the most interesting thing was the fly past that they organised. The rest of it was a bit dull. And we wait to see. We're recording this on Monday, whether the talks in DC are more fruitful today. But yeah, I don't think this is a narrative or a story that markets are especially bothered about right now, at least not in terms of the equity complex.
Yeah, it won't be bothered until it's bothered. I'm going to slightly take the other side. I think. I think if the worst, if the worst case happens and nothing's done, Zelensky says we're not going to cede to any of those demands, and Trump throws his hands in the air, because really, forget the coalition of clowns that continually waffle around and try and get involved. It's really been Trump who has dragged people to the table several times, and if he throws his hands up and says get on with it. That's Europe on the hook for more money to pile into Ukraine. That might be the US saying, well, we're not going to put more money in there. And then you're talking about Russia, where they steamroll across the whole of the country. And then what that brings for NATO, having everyone having Russia basically on the doorstep even more. So I think the knee-jerk reaction to Trump throwing his hands up in the air is what will scare markets the most initially, and then we'll have to see what happens from that point.
Well, that's a nice and cheerful way on which to move on to our plays of the day, isn't it? Thanks for that, mate. Oh dear. Right. What are we looking at this week? Actually, I'm going back to a topic we were discussing a moment ago in terms of rate expectations here in the UK. We talk a hell of a lot about what markets are pricing for central banks, but we don't often talk about trading that. So I thought I'd change that this week. What we're looking at here is the rates curve here in the UK, specifically the March and June 2026 SONIA futures. SONIA is not the name of someone we know. SONIA is the sterling overnight indexed average, basically the way of trading rate expectations here in the UK. As you can see from the charts here, even by next June, the market is not fully pricing 50 basis points worth of easing here in the UK, which, as we mentioned earlier on, feels far, far too hawkish. Yes, there are upside inflation risks here in the near term, but with the labour market continuing to weaken considerably and rapidly, the demand side of things looking pretty weak, and of course with the potential, well, I say the potential, I mean it's basically a certainty at this point, of further significant tax hikes being delivered in the autumn budget, I think the market pricing is far too hawkish and far too optimistic. Given how weak the outlook is here in the UK, the risk reward strongly favours a dovish repricing of these expectations. As we touched on earlier, it could be a soft CPI number. It could be even the Fed starting to sound a little bit more dovish and dragging rate expectations elsewhere along with that. But I think that could be a spark that causes quite a rapid repricing of rate expectations here. And the way you'd express that is by being long both of these contracts, which right now, as we've discussed at length in the show, does frankly feel like a little bit of a no-brainer, to be honest. Ryan, you're also revisiting a topic and going back to New Zealand.
Yeah, as I mentioned close to the top of the show, I'm already looking at a trade for the RBNZ in Aussie Kiwi, but I'm also looking at Kiwi dollar for a bit of perhaps a dovish dip buying opportunity. Now, this one might need a decent shove to get it down to the level I'm looking at, but if the bank do remain firmly dovish, a dip to my 58.40, 70 zone will be something I'll be looking at for long, at least for a return back up to the 59s. But after our conversation, I don't know, I'm not looking at cable, considering we think both the Fed and the Bank of England might be wrong. So I might pencil that in for next week.
Well, there we go. I'll leave you to do that, and I'll wrap up the show, because that does bring us to the end of proceedings for another week. Thank you very much, as always, to our good friend, well, he's Kyriakos' friend as well. He's certainly mine, Ryan Littlestone, for a Forex Slow Live.
You're my friend too.
Sorry, mate.
You're my friend too.
Oh, bless. How sweet. Thank you to Kyriakos as well for bringing things together as brilliantly as always, and being slightly less of a shambles than the host seems to be this week. In any case, hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if there's anything in particular you'd like us to discuss in next week's episode. And that's when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead. Goodbye for now.